London is probably the oldest startup ecosystem in Europe, and it really only got going circa 2010. What Europe has achieved in 15 years is nuts.
What would be for you the main differences you've seen with, the investment scene in Europe?
In parts of Europe, it's a shame that leaving academia to go and found a company can be seen as checking out from the kind of purist academia route. Whilst in the US, many PhDs are actively encouraged to go and commercialize their technology and innovations in the real world.
Hello and welcome to VC2, the podcast that helps you become a smarter impact investor and a better climate tech entrepreneur. Today, we're joined by Matthew Blain, principal at Voyager Ventures, a VC firm investing in climate tech companies in North America and Europe. We will discuss why we need to break barriers in the European climate tech ecosystem, and we will explore the similarities and differences between the US and Europe. As always, if you like this episode and if you like the show, don't forget to give us a 5-star review on Apple Podcasts and Spotify, and to subscribe, like, and comment on YouTube. Let's dive in. This episode is sponsored by Buresol, an AI-driven energy company transforming how businesses store, manage, and consume energy. Buresol's energy as a service model makes clean energy adoption seamless, helping industrial and SME achieve energy autonomy, cost optimization, and sustainability without any upfront investment. They are now expanding in France and Europe, and they are launching their first commercial projects. So if you want to learn more, you can find the link to their website in the description of this episode, or you can reach out to their CEO, Felipe Ariola. Back to this episode. So Matthew, thank you so much for coming on the podcast. You've been an investor for many years. You've invested you were in San Francisco before, you were in New York, and then recently London. I was curious, why did you decide to come to London to invest?
So firstly, thank you very much for having me on the podcast. It's a pleasure to be here. And secondly, thank you for the very kind intro. I would make a short clarification that I've been an investor at Voyager for about 2.5 years, which is up to you whether you describe that as many years. I was an angel investor before that and have been around startups for a long time, but not necessarily as an investor. But why did I come back to Europe? So I'm hugely passionate about the potential of this ecosystem. I think on almost every metric across the board, there's a lot of reasons to be excited about its potential, particularly in the climate space, on both the deep tech and the software side. So maybe to drill into both of those. On the deep tech side, Europe has 3 of the top 10 research universities in the world, 4 of the top 15. The quality of research here is extraordinary.
What are they? What are those universities?
Oxford, Cambridge, and Imperial, I think, is the 3 in the top 10. But moving away from those kind of academic tables, I think any climate investor in Europe or North America would have extraordinary respect for TUM, specifically in Munich, and ETH in Zurich, as well as Polytechnique in France and Denmark as well. There are fantastic academic institutions and research institutions across the board. So we're very excited to help commercialize that technology. On the software side, I think, speaking plainly, if I reflect on the 10 best software companies that I've seen over the last 2.5 years that I've been an investor, I would actually say possibly 8 or 9 have been European companies within the climate tech space. On the deep tech side, we've traditionally seen slightly stronger deal flow on the US side, and I can explain why. There are lots of reasons for that. But on the software side, we see fantastic deal flow in the climate tech space here. So we have always had an equal focus of investing in Europe and North America. The fund has always had the vision of building the leading early stage climate tech VC in Europe and North America. When we were founded 3.5 years ago, it didn't make a lot of sense to spread ourselves out across 8 time zones at such an early stage. But we agreed 2.5 years ago that I would move across in 2024 to launch the European office from London, and we'll be expanding the team across Europe from here. So lots of reasons to be excited about this ecosystem, and I'm delighted to be back.
Yeah, and there's a lot that we will cover in this podcast today. I think the first thing for me to understand is, with your vision of, like, you've been in America, you've lived it, like the investment part, the startup part, even in San Francisco, where like it's probably super active compared to what it is in Europe. What would be for you the main differences you've seen with the investment scene in Europe?
It's a good question. So firstly, I'd like to set the scene. I think in Europe, one thing that I would like to help change is, I think in America, Americans tend to default to So bigging that ecosystem up, and it's a fantastic ecosystem, probably the strongest in the world. And in Europe, we have a terrible habit of playing ourselves down. So I think, just to set the scene, I think Europe is an extraordinary ecosystem today at the global level.
Like, is Europe underrated in the eyes of many people?
By Europeans, undoubtedly. Yeah, I really mean that. You look at almost any metric, we're jostling with China for second place globally as a European startup ecosystem. The European startup ecosystem, according to Atomico's State of European Tech report in 23, has been growing at a faster rate than the US for the last 7 years. In terms of early stage company formation, having 10 years ago been a fraction of the US's, we're now roughly neck and neck. 10 years ago, we didn't have any growth stage capital, or we didn't have much. Now there's lots of growth stage capital, mostly for software, and we need more, and I can talk about that in more detail, particularly with a greater risk tolerance. But if you think that London is probably the oldest startup ecosystem in Europe, and it really only got going circa 2010, what Europe has achieved in 15 years is nuts. And occasionally you see charts of enterprise value showing the number of companies worth over 10 billion in the US and the company's number worth over 10 billion in Europe. And there's lots of large circles in the US and not many large circles in Europe. But enterprise value takes a long time to build. A lot of those large circles in the US, like Microsoft and Apple, were formed in the 70s. Apple is the 90s. NVIDIA is kind of similar age as well. Google's not a young company either. All of Europe's unicorns, Revolut, Monzo, Checkout.com, Spotify, a little bit older, are much, much younger, and enterprise value takes time to build. So I think there's a little bit of a confidence issue in Europe, and I'd like to be part of kind of, with that visibility across both markets, would like to be playing my part to change that and give European founders and investors the confidence to build for global success rather than just European or national European success.
Yeah, that makes a lot of sense. And what I like about Voyager is that you are both in the US and Europe, so that you can also help the startup move across if they need to, and grab that American market if they need to. But going back to what you said, you make a difference between software and hardware companies. How does that difference plays out between US and Europe? For example, let's start with software.
So in software, that's maybe more positive on the European side within climate. So energy is a big part of the climate tech ecosystem, and is a big part of the commercial opportunity of the deals that we look at as a segment. And in that space, Europe is generally further ahead than the US in terms of how deregulated the markets are, in terms of how forward-thinking the regulation is. And that has opened more opportunities, in my opinion, for startups to found innovative business models in the European market. On top of that, many corporates in the US, particularly following the election in November, are hesitant to make, or at least publicize, significant action on climate. They're concerned about a potential backlash at the boardroom level. It's a more populist issue in terms of the risk of blowback, whilst European corporates, in my experience, are very open to working in the space, to procuring interesting software technologies, to do interesting things, to reduce their climate impact and improve unit economics. And so there's a greater openness amongst the customer set as well. And those two things combined mean that it's a really fertile ground on the software side. On the hardware side, the US has some significant advantages. I think some of the well-known ones are that universities are very well funded and very wealthy and can fund a lot of research. I think more importantly, as the numbers I shared at the start indicate, the quality of research is also very strong in Europe as well. But I think more importantly in the US, there's a greater culture of entrepreneurialism within academic institutions. In parts of Europe, it's a shame that leaving academia to go and found a company can be seen as checking out from the kind of purist academia route. Whilst in the US, many PhDs are actively encouraged to go and commercialize their technology and innovations in the real world. And that makes a big difference in terms of the pipeline of really exciting IP coming out of research institutions and into the startup space. The second thing that I think they do better than us is the support infrastructure that takes an exciting piece of IP out of a research institution in the US to a really, really large company. And I think, and I'll come back to this in a second, I think the most important part of that is the accelerator phase, where within climate, you look at organizations like Activate, which is an incredible deep tech accelerator in the US, where they provide 2 years free lab space, 2 years free office space, 500K non-dilutive funding, optional uncapped safe notes of about 200K from 2 VC funds, access, and this is a really important part, to best-in-class mentoring in founders, connecting founders to other founders who have built big businesses in that space. And the reason I think that's so important is, even with the earlier advantages, when you go to an event showcasing the new entrants into these accelerator programs, a lot of those academic PhDs going into these programs in the US look and sound exactly like European deep tech founders. But because they don't have this pressure to immediately go out to market, probably get diluted too much and kind of already set themselves up for a challenging path, they have a lot of time to go and spend a lot of time with customers, work out exactly the best strategy for product market fit. As soon as they enter programs like this, they get bombarded by investor interest. So they kind of get knocked into shape a little bit in how investors think about their problem. And in Europe, we just don't have that. We have a lot of programs doing a lot of fantastic work, doing pieces of that. But typically the programs are much shorter, 6, 12 weeks. The amounts of money and the pressure to raise comes sooner. And as a result, I think that's where you start to see a bit of a divergence. And then beyond that, grant financing piece in the US has historically had an advantage. Organizations like RPE, SBIR, providing smaller grants for earlier stage companies. I think the gap there has really closed. I think Europe has done a fantastic job over the last 5 years of setting up grant structures, whether that's Sprint in Germany, doing a fantastic job backing really innovative research, or whether that's ARIA, the Advanced Research Innovation Agency in Europe, or BPI France in France. There are lots of fantastic grant allocating agencies. So there, I think the gap is really closed. But the final stage, which the US has done well, although they are on the verge of shooting themselves on the foot here, is the Loan Program Office, where everyone in the climate space is aware that we have a problem financing first-of-a-kind facilities. The Loan Program Office was set up specifically to address this by offering large amounts of money. So in the case of Tesla, I think about $400 million to build their first factory in Fremont. They were explicitly set up to give out loans that were too high risk for commercial lenders and way too much money for the company to raise equity. And that is how Tesla financed their first factory. And as a result, they built one of the largest, or what was until the last 2 weeks, one of the largest companies in the world. I think there's an extraordinary opportunity for European countries to copy that structure. It's been proven to be successful. There were failures like Solyndra, but on balance, the returns of that debt fund were positive and successful and had huge knock-on benefits for the ecosystem as a whole. So if I can go on further, I think in Europe, we historically didn't have much growth capital, and it was a problem that a lot of investors and founders pointed to. That has definitely changed over the last 10 years. There's a lot more growth funds and a lot more growth capital available, but it is heavily focused on software. And I think from a first principles perspective, I don't think many of the European growth funds that I know would be able to back a company like Uber coming through with very, very low gross margins at a Series B or Series C. You typically have a much lower risk tolerance. And that's because a lot of the growth funds in Europe are relatively small, 400 million, 500 million funds, and they're writing 50 million euro checks. They only have 10 bets. And if one of those goes to zero, the returns of their fund are going to be really, really challenging. And they're only underwriting to a 5x return. So they have to play it safe. And so I think the growth stages in Europe are increasingly starting to work for software companies. But in deep tech company, there are not many funds who can go and write significant checks into a hardware-based business with a gross margin of 35 to 50%, sub 50%, of which quite a lot of climate tech companies fall into that bracket. So I'll pause for breath there.
As an investor yourself, how can you help drive that change? Because, like if I listen to you, I should maybe build an accelerator for this type of startups. Like what are the things that investors can do to help drive changes and get to parity, if not ahead of the US on that race to climate tech startup?
Yeah, I think come on podcasts like this and talk about it. No, I think that's
I wish that was easy.
I think that's part of the puzzle. I think I'm also very passionate about highlighting the opportunities for learnings across both ecosystems. There's things the US can learn from Europe, and there's many things Europe can learn from the US. But it's also talking to policymakers. And again, it's something I'm very passionate about as well, and do my best to make connections there to share some of these learnings and findings from the front line. But Europe is working on these things. And again, I get frustrated when there's a sense, oh, there's no government support, they're not listening. It's just not true. I think, again, to take a UK example, it's been a problem across Europe, spin-out terms for technology coming out of universities. Historically, so what needs to happen is when an IP that was developed within a university, when it spins out, it's important that the university receives some return for the fact that it was developed using their infrastructure. But historically, there has been a gross problem with universities trying to take 20, 30, 40% of the company, which makes the company uninvestable from an investor perspective, because the pre-seed investors or the seed stage investors are modeling what's going to happen to that company's cap table over the next 10 years. And they can see that within 5 years, the founders are going to own such a small slice of the company, they're not going to be incentivized to stay. So if a university goes and takes 40% of a deep tech company spinning out of a university, it's a bit different in biotech. Biotech, those kind of ownership thresholds are more normal, but within climate tech and software, you can't do that. It has to be much less. And it's been a huge problem. And universities say, oh, early stage investors are just being greedy. And early stage investors are going, oh, but universities are making these companies uninvestable. Well, in the UK, the government listened to this. They conducted a huge government review exploring the problem. And the review came back with a large number of recommendations in, I think, Q3 last year. The government agreed to all the changes. So this goes down to setting standardized terms for software companies and slightly different standardized terms for deep tech companies, alongside changes to how universities are incentivized. Historically, they have been a cost center that receives money from the government. And there has been a tiny, tiny line item in their incentives that says something along the lines of they can keep some of the money from commercialization, but there's been very little incentive for them to try to make money through commercializing their research. That was one thing it changed as well. And already, I think over 150 universities, including all the top research universities in the UK, have signed up to this. And this problem has been there for the last 15 years, has now, to a fair extent, been solved. I think the standardized terms are still a bit high, but it's a huge step in the right direction. So again, another example of why I think it's important to push back when you hear broad statements saying, oh, there's not enough government support. I think there's a lot of government focus on this, and it has made a real impact. Another example would be sorting out options in Germany, which has also happened recently, which is a very exciting change.
And you mentioned earlier on the software side, now companies didn't have much of a problem to go across Europe and capture new markets. Do you see an issue with that on deep tech companies? For example, if you are an energy startup, I don't think Europe has a European energy market. I think infrastructure are very different across different countries. Like, how do you encourage, or how do you make sure that startups can go capture this European market to be comparable to the US? Because one of the problems I think with that is like Europe is a bunch of countries, where the US is one country with, like, for example, one grid, or like one type of grid, which we don't have in Europe. How do you make sure that funders can go and really capture the value of the European market?
Yeah, well, I would actually push back on that and say the US is not one grid. It's many grids, and they're incredibly segmented with very different regulation. It's something that really holds back the US ecosystem. And I would say European ecosystem is more cohesive in how it thinks about these things. So, I mean, this is one of the great advantages of the EU, right? And something that UK companies are suffering with in terms of ease of expansion into other geographies. I think I would turn around the narrative of the question and say this is actually an advantage of European companies, and we see international expansion and an international mindset happening earlier in most countries, not all countries in Europe. than we do in the US, where often when I ask them at Series A, what's your plan for international expansion? Occasionally it's the first time they've been asked that question. So I think that's an advantage. I think it's up to us as early stage investors to encourage founders to maintain that international mindset right from day one. And I think it's something we should lean into as a competitive edge.
Yeah, that's very interesting. Yeah, I think it goes back to also one of the statistics that I like, because I spent a bit of time in the US, and I think something like 50% of Americans never went out of the country. While like if you go in Europe, like most people would have at least been once to another country, because obviously like the distance are shorter and everything. But I think it's a novel mindset of, whether or not you want to go global.
But we have a different problem in venture, which is whilst American companies often haven't thought about international expansion by Series A, what they're not sure of is global ambition in the long term. Most American companies, most American startups see themselves as building kind of global titans in the mold of a lot of the large tech companies that are dominating global stock markets today out of the US. In Europe, and I'm still trying to pin my finger on where this happens, a lot of founders and investors build for Europe. A lot of investors only invest in Europe. And you ask, why aren't you investing in the US? And they go, oh, it's too competitive. We wouldn't win, et cetera, et cetera. And I just find it interesting when you speak to American investors, they'll happily opportunistically invest in Europe, and European investors are like, oh, no, we wouldn't. And I think that filters through as well. And when even some of the top startups that I've spoken to in Europe are surrounded by European-only investors who don't invest outside that geo, their horizons are narrower, and I would like to see more aggressive ambition to build globally dominant companies from both founders and investors. And I actually think there's more work to do on the investor side than on the founder side. I think a lot of the top founders are really committed to that, and then they enter an ecosystem which is heavily Europe focused, and they get kind of taken to one side and go, oh, we'll just capture this market, and that's a $10 billion euro opportunity. But I would love to see, more European investors, more European founders go, it's a 10 billion euro opportunity in Europe, and that's the beachhead. And we're going to go and build a 100 billion euro company by expanding into all of these geos.
Do you think there's a lack of ambition across Europe?
Not with founders. I think, as I touched on before, I would like to see more early stage European investors encouraging that kind of ambition to build a globally dominant company from the beginning. As I think the mindset starts there, and people often talk about the trend of European companies successfully building in Europe and then exiting to a big American company. That is a natural pathway for many companies. But I think if you take it Wiz as an example in the US, they turned down a $20 billion acquisition offer from Google because they saw a $100 billion opportunity. That would never happen in Europe. And I'm not saying it should happen. That's a pretty crazy situation. $20 billion is an amazing exit. But I do think you're not going to build the NVIDIAs, the Googles, the Facebooks of the world, the Amazons of the world, unless you have the kind of mindset of Mark Zuckerberg and Jeff Bezos, who are like, no, I'm going to go build this global behemoth. And I think too quickly people look for the exit door after capturing Europe.
And do you think we have an advantage when it comes to climate tech because also of like the mindset of consumers overall? Because I feel like when I came back from the US, what I felt coming back into Europe was that more people are concerned with climate in general, which means that obviously it also like leaders are more concerned, and consumers and corporates. Do you think we have an advantage in climate tech in Europe versus the US?
So I think we do, but I don't think it's for the reason you're alluding to there. I think it depends what you want to build. If you want to build a consumer-facing company that sells only to Europeans, then it's great to have an engaged consumer body to sell to. But if you want to go and build globally dominant companies, the way you do that in the climate tech space is through superior unit economics. A company with a green premium, whether that's aluminium or a bank account, you can sell to a small proportion of the market who are really passionate about the problem and are willing to pay more, but you are never going to achieve global adoption. The way you achieve global adoption is by building something that is better, faster, and cheaper than the fossil incumbent. Unfortunately, many of the industries in the world today are underpinned by technology that's over 100 years old, and there's a fantastic opportunity to build companies around modern technology that has the potential to be better, faster, and cheaper. And so I think the fact that more Europeans are engaged on climate is a great thing. I think it increases the pipeline of talent to climate tech companies in Europe. I think it increases the pipeline of companies in Europe focused on climate, both of which are a great thing. I think it gives a positive early adopter customer base for a lot of technologies. But does it give us a global edge just because we're passionate about climate and we're going to prop up a climate tech company with a green premium? No, is the answer. The key is superior unit economics. But as I mentioned, it does provide advantages in other places like talent.
Well, I guess two sections I would like to address before the end of this episode. The first one is on technology or trends. Have you observed some technologies where like Europe is better than the US and the other way around as well? Like, do you see some trends in the type of projects you see in Europe versus the US from a climate tech perspective, obviously?
Yeah, I think it goes back a little bit to my answer earlier in terms of the deep tech versus software side. I think everything around energy procurement, energy management, and demand response, so how consumers and companies procure energy, how they manage the energy they use more efficiently to reduce the energy consumption and crucially reduce cost, and then how they flex when their assets are charging or when their oven is burning, etc., in response to what's happening in the grid. Europe is way ahead around that whole orchestration piece, which I think with the visibility that I have in this chair is where the global economy is going to go in terms of how our grid operates, because it's more efficient and ultimately makes money. So on all of those points, Europe is much more exciting. On some specifically within the compute space, some technical hardware subjects, particularly within the computing, semiconductor, data center cooling spaces, there's some fantastic research coming out of places like Switzerland and southern Germany in that space that's really exciting. And we possibly see more interesting innovation there than in the US more recently. But in the US, anything that requires big infrastructure, whether that's, second life batteries or battery recycling or processing critical materials or critical minerals, anything like that requires big infrastructure, they're just way ahead. And it's partly investor appetite. If someone goes and projects that as a roadmap in the US, there's many more investors who are excited. Well, there's many more investors in Europe who are like, oh shit, that sounds like a big factory and I'm scared of that. But I'd say those are the two main themes.
And I guess another section I wanted to address with you is like, how can we partner more? How can investors in Europe and the US partner together to bring these companies globally, whether they are American companies where like European investors invest or the other way around? Like how can they go together and instead of like trying to fight, actually, try to collaborate to make sure that the greatest company actually scale and succeed?
Yeah, I think this is a good question. I think venture capital is quite a unique industry in the sense that someone can be our partner one day and our competitor the next day. It's one of the fun things about this industry. And I am quite passionate about, the way you break down these silos, which within Europe are national silos. Historically, VC funds have had quite national focus, basically. German funds invest in Germany and have dominance there. French funds invest in France and have dominance there. I would really like to see at the regional level greater interaction, greater integration of funds across Europe, including the UK, free-flowing talent to back the best businesses and help that early international expansion. I think that's really important. I think you increasingly see it. I have a lot of friends in France of French funds who have been more aggressively investing outside of France, which I think is great to see. A lot of my friends in Germany are doing likewise, opening offices in France or in the UK. And I think that's really healthy, and that integration increases the international focus, all of which helps what I talked about earlier in terms of the progression towards globally dominant businesses. The next chapter, I would love to see more of the top European funds aggressively enter the US market. I think I see both markets equally. I see the quality investors in both markets. There are definitely some fantastic European funds that could do a brilliant job in the US. I don't think many European funds have cracked that historically, but I do think that's an opportunity. And I think that would help facilitate the flow of the best technologies and companies from Europe into the US. I think the transition from the US to Europe has historically been easier. And maybe that's partly because a lot of the top US funds have offices and teams in Europe, and they understand how both ecosystems work. So to answer that question, I would like to see a greater proliferation and integration of the venture capital network, breaking down these silos to facilitate the flow of information, growth across borders. Because at least in the early stages, those venture capital networks are kind of where deals and companies and trajectories are set. So that's kind of how I would say how we can partner within what we do in early stage venture. And more internationally, I think we're in a real arms race, actually. There are fantastic opportunities for countries to capture economic opportunity from developing the industries of the future. I think the US had historically been a little bit of a laggard, and then the IRA came out and CHIPS Act came out, and they made fantastic progress in a short amount of time and attracted a lot of next generation companies. I think the recent policy changes put a lot of that at risk, and Europe, which had been doing very well prior to the IRA in attracting these new industries, has a real opportunity to take the initiative and set up these industries of the future within Europe to reinvigorate our manufacturing base and our economies. And maybe that's a little bit less collaborative and more competitive. So I think it's a blend.
Yeah, I like how you think about venture capital as like one day you're a partner, the next day you're a competitor. I think that's very interesting also as a mindset. Well, look, we have two last section. The first one is you got a question from one of my guests, Alina Klauner. I sent it to you on your phone just before, so if you want to pull up your phone, she wanted to ask you a question about this very topic. So I'll let you listen to it.
Yes, I would, with all of the happenings in mind, all of the news that we keep seeing out of the US and sort of the various reactions. I would love to hear a little bit about how he thinks about the values and how you defend the values in the way you invest, the way you interact with founders, the way you interact with the ecosystem.
Interesting how I defend the values. I think it might be helpful to highlight what those values are. And I think they'll speak for themselves. So I think, firstly, in how we see the opportunity as a climate tech fund, it's important to remember that climate tech funds are for-profit organizations, not for profit organizations. And we are ultimately responsible for deriving a financial return to our investors. And the way we do that, as I alluded to before, is by identifying companies that are better, faster, and cheaper than incumbent technologies through superior unit economics. That's how you get global adoption. So in terms of the values, before Trump, during the Biden years, throughout history, within the deep tech and hardware space as well as software space, that is how you build customers that products love. Products that customers love. And so our values have never changed there. On how we interact with founders, I think something I'm very passionate about within the venture ecosystem is recognizing the extraordinary individuals that founders are and the extraordinary lengths they go to realize their vision, and constantly maintaining the humility in how we interact with them. I think it's very easy for investors who are in a position of power, where they are saying yes and no to people a lot, to end up with slightly inflated egos about their role in the market. And so I'm very passionate about maintaining humility and supporting founders wherever I can, and really hustling to reflect the extraordinary hustle that they're showing in building their business. So again, that is also unchanged based on what's happening in the US. But I want to loop back to the first bit, the unit economics piece, because I hear quite a lot of catastrophizing within the climate tech space, also particularly in Europe, but also in the US. When you crack those unit economic equations, the progress is extraordinary. Take Texas. Texas deployed more grid-scale batteries last year than California. Texas is not doing that because they care about the climate. They're doing that because of superior unit economics. 20% of all cars globally sold last year were electric vehicles, up from 13% 2 years ago, despite all of the negative headlines. A significant part of that is in the developing world, particularly places like China. And those are not climate-led decisions. Those are unit economic decisions. I think heat pumps outsold fossil gas boilers in the US by 30% last year. Public policy, the winds of public policy can blow in both directions. I've been engaged in climate for 15 years, originally studying climatology at university, and you see the winds blowing in both directions, but the trajectory is totally consistent. And when you reflect that 85% of new energy infrastructure globally in 23, 85% was wind and solar, and you start to hear people say that climate tech is dead because of one election in one country, I think they're mental. So To answer that question, I'd push back a little bit on the premise. The election happened. I don't think it's the disaster that people think it is. Unit economics is driving this transition faster and further than I would ever have expected 10 years ago across the world. Yes, we need to move quicker. Yes, it's not a time for complacency, but it's also not a time for saying everything is screwed, because hopelessness breeds apathy and we need more action, not apathy. And so our values have not changed. Unit economics underpins the key to commercial success, and supporting founders with humility and aggression and drive wherever we can to help them on their journey. So nothing's changed.
I love that. Well, it's interesting because, as I was saying earlier, in this podcast, I'm trying to build my mental model. Two things I'll for sure remember for today is one, unit economics is key. And the second one is really the humility part. I think I wish I was hearing more that word from a lot of VCs. I think founders are incredible people. They have an incredible drive. They're willing to sacrifice a lot of their life to their project, which I think is maybe a little bit different in VC. It's maybe a bit more comfortable as a role. So I really love that part. Well, look, one last section for today. It's the fire question. I'll ask you to be super quick, 1 sentence maximum per question. We'll cover 10 questions in the next 5 minutes. Are you ready for that?
I'm not at all ready, but I will give it a go.
What's the biggest misconception about European climate tech?
That founders don't move quickly.
What's one thing European VCs should do differently?
Build for global success.
What's a US climate tech innovation Europe should adopt?
The Loan Program Office.
What's the biggest challenge for a European founder looking to scale globally?
Recognizing that product market fit will be different for different customer bases in different parts of the world, and adapting to that without customizing the product. Very tricky balance.
What's one advice for an American investor looking to invest in Europe?
Spend time here in person.
And for the other way around, a European investor looking to invest in America?
Spend time there in person.
I love that. What's the most underrated climate tech that you've seen?
Float batteries.
If you were a VC, what role would you play in the fight against climate change?
Founder.
What's one green flag when looking at a startup?
Extremely fast learning over time. So how quickly they learn is the best metric for how successful the team will be, how quickly they can adapt to new situations, and how fast they'll grow.
And what's a red flag on the other side? You can't say the opposite.
Being in love with the technology and not in love with the customer problem.
Very interesting. What's one piece of advice for a founder entering the climate tech space today?
I'm going to give you 2 sentences. I think we see a lot of companies in similar spaces in Europe. So really making sure they have a clear story about why their technology is differentiated from some of the things that have moved, the early movers in each space, of which there are many, and why their trajectory will outpace those early movers.
What are the 3 most important things to be a successful impact VC?
Humility, speed, and ambition.
I love that. And I will add one thing that you mentioned earlier before we started recording. Be close to the founders, understand who they are, how they work. That's, I think, one great advice that I got from you today. What's one resource, like a podcast, a book, a movie, I don't know, something that people should listen to or watch after this episode if they want to learn more about the discussion we had today?
I think of the podcasts, I like Shale Khan's Catalyst the most.
Obviously.
Columbia Energy Exchange is also good. I think in terms of books, Venture Deals is fantastic as a blow-by-blow play of the mechanics of venture capital. It's something I continue to refer to as obscure terms in term sheets come up. And then also love the team at Climate Tech VC and Sightline as fantastic, accessible, data-focused news on all elements of the energy transition. If you stay on top of those things, you'll be very well informed.
Yeah, for sure. I was actually lucky enough to be featured in one of the Sightline newsletter, which I was very surprised with, but very happy with. One last question. Who's the next climate general partner that I should interview, or general like VC that I should interview?
Stanislas Lott at Daphne.
I think he's on paternity leave right now, but I'm trying to get Stanislas afterward.
In which case, Philip Emick at Picus.
Well, great. I love this episode. If people want to reach out to you, if they have a startup that they would want to offer to Voyager, or like if they just want to reach out to learn more, where can they find you online?
LinkedIn. They can reach out to me on LinkedIn. I respond to everyone. It might take me a little bit of time, but I do respond to everyone. Secondly, if it's a company, the fastest route is to reach out using the contact form on the Voyager website. We respond to all of the inbound we get within 2 weeks, and either myself or my colleagues will review it and share our thoughts. So if it's a company, go through the website. If it's for something else, then come through LinkedIn.
Well, thank you so much for today. It was a pleasure to have you on the podcast. And listeners, if you like this episode and if you like the show, don't forget to subscribe, like, and comment to the YouTube channel, or give us a 5-star review on Apple Podcasts and Spotify. Thank you so much, Matthew.
Thank you very much for having me. It's been very fun.